one question we ask sometimes of people at the Fed is, why are we talking about rate cuts right now when the economy seems to be doing so well and weathering this 5.5% rate?
David, look, I think that there's something very fundamental that has happened that I'm not sure that the Fed has fully realized. I think the neutral interest rate is way above the 2.5% that the Fed likes to talk about. I think given the experience of the last several years that the market perceives normal inflation as probably being somewhat above 2%, at least on a CPI basis. And I think that huge deficits, more spending to come, substantial investment in renewables, substantial investment in resilience, substantial capital costs of various kinds associated with artificial intelligence, an aging population, meaning more dissavers, less capital flow coming from abroad. I think all of that means a much higher neutral real interest rate. So I think when the Fed compares 5% with the 2.5% neutral rate it sees, and people say that monetary policy is substantially restrictive, that's wrong. The neutral rate is much higher than that, and so monetary policy is much less restrictive than is generally supposed, and the clear evidence of that is that we have this supposedly really restrictive monetary policy and still have a quite robust economy. So I think the Fed needs to be very careful in its judgments about what would be an epochal shift from the regime we've had for the last several years to a regime of easing monetary policy. And they've moved substantially since December. Market used to be expecting 6 cuts in 2024. Now the market's expecting 3 cuts. And the Fed's carried that off skillfully. There hasn't been much disruption or dislocation as that change has taken place. But I think that's going to be there with us for the next while. And my own guess is probably that there's a little more adjustment to come, and the Fed may end up not deciding to cut quite as much as markets are now expecting. But I do think we need to get ourselves to an idea that neutral rates are closer to having a 4 handle than they are to having a 2 handle.
Larry, you, of course, are data dependent just the way that Jay Powell's data dependent, but consistent with the need for more data. We had Torsten Slok of Apollo this week come out and say he doesn't think there will be any cuts this year for some of the reasons you suggest. I'm not asking you to commit on what will happen, but does that seem plausible to you?
Yeah, I think I said on the show maybe a month ago, that several weeks ago, that there was a 15% chance that we wouldn't have cuts this year. I think if anything, that 15% may have drifted slightly upwards, and markets are kind of consistent with that if you look at options markets. So I think the base or presumptive case is probably that the next move is going to be down, but I think it'd be a real mistake for people to regard that as any kind of certainty. And I think the Fed has to be really quite careful here, because I certainly think we're at least at the foothills of bubbles, to mix a metaphor. I don't think right now financial markets have the kind of bubbly characteristics that they famously had at other times, but it's not that we're a million miles away from that either. And So I think that's something that also has to inform the policymaking process.